You are a professional student. You are welcome to another session of equity valuation. And in this session, common stock valuation model is our major assignment. And we are talking of stock valuation. Stock valuation is the process of determining the intrinsic value of a share of common stock of a company. Of determining what? Know this, intrinsic value. So there are two approaches to value a share of common stock. The first one is absolute valuation, which involves discounted cash flow method, and the second one is relative valuation, which I also call comparable approach. Now, when we are talking of stock valuation, the purpose of stock valuation is to find the value of a common share, which is justified by the company earning and growth potential. By the company what? Company earnings and growth potentials. Now, another reason for calculating or for finding common stock value is to identify undervalue and overvalue stocks, to also overweight and underweight them in the investment portfolio and generate alpha, that is excess return. I said alpha is what? Alpha is excess returns. We use valuation or stock valuation for the purpose of what? Purpose of justify the earnings and growth potential. That is one. Two, to know undervalue and overvalue stock, and also to overweight or underweight them. To overweight and underweight them. That's the purpose. And as I said earlier, we have discounted cash flow and relative valuation as two methods we use in valuing common stock. Now, when I'm talking of method, the first one is what? Is discounted cash flow method. And it is also known as absolute valuation approach, which attempts to find the easy value of a stock by discounting the future cash flow at a discounting rate which reflects the risk inherent in the stock. See, my brothers, if you want to know the value of anything, the value of anything is the what? Is the discounted value of all the income or cash flow from that thing. As a stock, for example, you want to know the value of a stock. The value of a stock is the discounted value or the present value of all the cash flow emanating from that stock. So, discounted, or let me say, the absolute valuation approach attempts to find the easy value of a stock by discounting the future cash flow of that stock at a discounting rate which reflects the risk inherent in the stock. As a result of this, it is also called discounted cash flow approach. So the common discounted cash flow approach valuation model include the single stage dividend growth model, which is also known as Gordon growth model. We also have multi-stage dividend models and free cash flow valuation. Those are the three basic ways that we use in calculating the value of a common stock using discounted cash flow. Now, let's start with distant growth dividend model. The constant growth dividend model, which is also known as single stage dividend growth model or Gordon model, is appropriate for valuation of a minority stake in mature dividend paying stock. Please note it. It is only used for what? Valuation of minority stake in mature dividend paying companies. So the stock value under this dividend discount model is equal to the discounted present value of the dividend per share expected to grow at a constant rate. And this is the model. This is the model. Equal to dividend multiplied by the growth all over R, which is rate of return on or cost of capital. R is what? Rate of returns or cost of capital multiplied by the growth. And when we are talking about the growth is what? Is gotten by 1 minus dividend payout multiplied by return on equity. That is on the usage of that. Now, for example, suppose dividend paid is equal to what? 2 naira 30 kobo, and the cost of capital is 13%, with a growth of 5% per annum. The price per share or the entry value of the share in this case will be equal to, when we use our growth model, all over R minus G. Our DO is 2 naira 30 kobo into 1.05, which is 5% growth, all over what's our cost of capital? 13% minus what? Minus growth, which is 5%. So what we have here is 2.415 all over 0.08. So the share is equal to 30 naira 19 kobo. This is the entry value. And if the price in the market price of the share is different from this, if it is lesser, if the price in the market is lesser, it means this stock is overvalued. And the best decision is to sell. But if the price in the market is higher than this, understand? If the price is in market, let me make myself clear. I said this entry value, which is 39.90 kobo, if the price in the market is lesser than this price, that is undervalue. Please, if I made mistake here, correct me and correct yourself. That is undervalue. If the price market is lesser, let's assume they are selling price in the market at the rate of 25 naira. It means that the price in the market is undervalued. So the decision here is to buy. That's buy decision. But if the market price is 40 naira or 35 naira, it means the stock is overvalued. So the decision is to what? Is to sell. This is how we use the constant growth dividend model to find the entry value of a stock in order to know the kind of decision to make in the market. This is actually used by fundamental analysts. So that is on that. Now let's look at the multi-stage. The multi-stage dividend discount model. The multi-stage dividend discount model can be used to value minority stake in company which are expected to have abnormal growth for some initial period, say 5 years, and the growth rate is expected to stabilize in the long run. So dividend per share per annum are forecasted based on actual growth rate in the initial years, and the value of the stock at the end of initial growth rate period is actually determined using the single stage dividend growth model or using some price multiples such as price earning ratio and dividend and internal or terminal value are discounted at the required rate of return. Now the model for that, if it is a multi-stage, is what we are looking at on the screen. The first dividend all over the rate of return raised to power 1. The second dividend, that is second year dividend, all over the same rate raised to power 2, up to the last dividend raised to power the number of year, which is n, plus the terminal value raised to power you discount the terminal value with the same rate for the same period as well. Understand? Now, DO is the current dividend per share, and R is the required rate of return of equity. So G is the growth rate of the dividend, which is known as a sustainable growth. Sustainable growth rate, which equal to the product of retention ratio and the return on equity. So the growth is equal to what? Like we said earlier, 1 minus dividend payout ratio multiplied by return on equity. So that is how the growth is calculated. Let's look at an example of this multiple or multi-stage dividend growth model. Now, example. Suppose the dividend are not zero for the first several years. For the first several years, the dividend forecast for the next 3 years are given below. Here, 1, 2, 3. Dividend expected. We have 1 naira, 2 naira, 2 naira 50 kobo. Those are the dividend for the 3 years forecasted. Now, what is required of us? The question is still continuing. Let's continue with the question. And after 3 years, question continue here. After 3 years, or after third year rather, after third year, dividend will grow. Dividend will grow at a constant rate, of 5% per year. The required rate of return is 10%. Now, question says, what is the value of the stock? What is the value of the stock? Now, what we need to do is that you have to know that when we are dealing with non-constant growth model, we should be able to identify when the constant growth will start. And in this our example, it is in year 3 that the constant growth will start. So the constant growth model can be used to determine the stock price at term 3. Understand? And we have to compute the present value of the stock price 3 years down the road. Then we had the present value of the dividend that will be paid between now and then. So the price in 3 years will be like this. So the price of the stock in 3 years will be equal to dividend in 3 years when the price will be stable plus the growth all over rate minus growth. And what's dividend in 3rd year is 2 naira 50 kobo plus 1.05, which is 5% growth, all over 10%, which is a return on equity minus growth, which is 5. And this one definitely will give us the value of the price in year 3, which is equal to 52 naira 50 kobo. So if that is the case, we can now calculate the total value of the stock at the present value of these first 3 dividend plus the present value of the one we got in time in year 3. And how do we go about it? The price in the first beginning we dividend in first year all over 1 plus r raised to power 1 plus dividend in second year all over 1 plus r raised to power 2 plus dividend in third year all over 1 plus r raised to power 3 plus the terminal value, which is 52 naira, that is dividend in any year all over 1 plus r raised to power 3 as well. So for the first one, it is 1 naira all over, our rate is what? 10%, that's 1.1 raised to power 1 plus second year, which is 2 naira all over 1 plus 1.1 raised to power 2 plus 2 naira 50 kobo all over 1.1 raised to power 3 plus 52 naira 50 kobo all over 1.1 raised to power 3 as well. So this one will give us what? It will give us, for the first one, we have 0.91 plus 1.65 plus 1.88 plus 39.44. So this one will give us what? 43 naira 88 kobo. So 43 naira 88 kobo is the value of the stock. I think we are clear about that. If you have any issue, don't hesitate to call us in our office. We have a lot of helplines that you can reach, and once you reach us, you definitely get a better information if this one is not clear. But when it's started good, we always give better information anytime, any day. That's why we are taking our time to get to the nitty-gritty of everything we are dealing in. So that is on that.